let's quickly recap as to what did we cover yesterday. Number one, we started with the income statement, and as you would recollect, so first what we have a sales or revenue from the sale of products and the services, and from the revenue we minus the cost of sales. What we get in our hand is known as gross margin. Gross margin is how we use in our company, but otherwise gross margin is also referred as gross profit. So basically gross margin, gross profit, there is no difference. So from the gross profit or gross margin, when we deduct the SG&A, that is selling, general and administrative expenses, together with the R&D expenses. So when we deduct the gross margin, when we deduct from the gross margin SG&A, what we get in our hand is known as current operating income or COI, and which is also known as EBIT, earning before interest and taxes. From the figure of current operating income, and we minus the restructuring cost, as I had explained to you yesterday, impairment losses and other exceptional operating expenses or gain, what we get in our hand is known as operating income. And I'm sure you can understand why it is known as operating income, because this is the income that we are earning from the operations of the company, operations of the business, and that is why it is known as operating income. From the operating income, we will make the adjustment for gains and losses on securities, gross financial charges, which is our interest cost, financial revenues. Sometimes we may deposit our surplus money with the bank and earn some interest on that. So that is our financial revenue, and exchange rate and loss, gain and losses. So we adjust for these in the operating income. What we get is known as profit tax income, before tax income, or income before tax. So both mean the same thing. And it is from this profit or income before tax, from this figure we minus the amount of income tax, and what we get is in our hand is known as net income. Now please remember, this net income is also known as net profit. It is also known as bottom line. It is also known as earning after tax. And why I am telling you all this, so as to create more awareness that sometimes the terms used may be different, but meaning is still the same. So you call it net income, net profit, profit after tax, or earning after tax, or bottom line. They all mean the same thing. So this is what we had covered yesterday. And then we move to the balance sheet. So a quick recap of the balance sheet also. So remember, any company anywhere in the world will have to make a balance sheet as part of its financial statement. And that balance sheet will comprise of two things. Number one is the liability, and number two is the assets. Liability is something that company owes to outsiders, and asset is something that company owns. So in the liability, there are three components. One is equity plus retained profit. Equity, share capital, you all understand. So when a company is started, the owners or the promoters, they infuse capital by way of equity. That is known as equity. And remember, subsequently when the company starts running, it starts making profit. Assuming it starts making profit, the profit that the company earns, what the company does with the profit, part of the profit company gives to the shareholders as dividend, and remaining profit is kept in the business for the expansion, diversification, and things like that. The profit which is retained in the business is referred as retained profit. And I'm sure you can understand why it is known as retained profit, because this is the part of the profit which has been retained in the business. And so that is one component, equity plus retained profits. Retained profits, please remember, are also recorded in the books as reserves. So the another name for the retained profits which are kept in the business is reserves, right? That is what you would see. Then you have a long-term liabilities and you got a short-term liabilities. Short-term liabilities are the liabilities that the company is obligated to discharge within a period of 1 year. Those are short-term liabilities. And what are the long-term liabilities? Liabilities which are not short-term liabilities are the long-term liabilities. That means the liabilities of a business which are supposed to be discharged by the business beyond a period of 12 months are referred as long-term liabilities. Then the second component of the balance sheet is assets, and the assets, again you have two types of assets: long-term assets and the short-term assets, or the current assets. Current assets are like inventory, receivable, cash and bank balance. These are the current assets. And why these are known as current assets? Because these are flowing continuously. So you get the inventory, you convert it into finished product, you sell it in the market, you get the cash. With the cash again you purchase inventory. So these are flowing like a current, and that is why these are known as current assets. Current assets are expected to get converted into cash within a period of 1 year. And what are the long-term assets? Again, the definition of long-term assets is very simple. Assets which are not current assets are long-term assets. And the other significant role that the long-term assets play in a business, that is, the long-term assets are used for converting the current assets into cash, and that is what we should remember. So friends, this is what was our focus yesterday, and now we go to the next topic. And the next topic, that next statement that we have, is the financial
One
statements.
question on, sorry.